Today we'll be looking at why everything changes when you use an S-Corp when it comes to your tax plan. As a registered CPA and owner of a tax technology company, TaxHome, we've seen how the S-Corp structure can be the secret to unlocking dramatic tax savings and wealth building opportunities that other entities miss. And that's exactly why we're making this video today, to show you why an S-Corp could be the game-changing move your business needs right now. All right, let's dive into it. So the number one reason, the reason that we look at S corporations in the first place is the ability for you to save on the amount that you're paying in self-employment taxes. So let's break this down. If you're set up as a sole proprietorship or a single member LLC, you're going to pay your normal income tax rate on 100% of your income. So whatever tax bracket, tax rate you're in, you're going to pay that on the profit of your single member LLC, your sole proprietorship, whatever it might be. But on top of that, you're also going to pay self-employment taxes, which is 15.3% on 100% of your income from that business. So let's imagine that you have a business, a sole proprietorship that profits $100,000 a year. You're going to pay your normal income tax rate, but you're also going to pay self-employment tax on that full $100,000, which is roughly $15,000. And so that is the major downfall of having a sole proprietorship, is that you're paying self-employment taxes on that. And that is the major problem that an S corporation can fix. So let's talk through how an S corporation fixes this concept or this idea of self-employment taxes. With an S corporation, we remain an LLC. So if you're an LLC, you're going to stay an LLC. We're just electing for your entity, your LLC, to be taxed as an S corporation. And when we make that tax election, the IRS requires that S corporation owners take a reasonable salary for the work that they're doing. And that reasonable salary piece, you're going to pay self-employment taxes on. Now, they don't call it self-employment taxes. It's called FICA taxes, but it's exactly the same thing in exact amount as what self-employment taxes are. So as an S corporation, you're required now as an owner to take a W-2 payroll salary to yourself, and you're going to pay self-employment taxes on that payroll salary that you're taking. But the beauty is that any income or profit that your business makes over and above that salary that you took, you're not get hit with self-employment taxes on. So let's go back to that example. The example we gave is a sole proprietorship, single member LLC with no S-Corp election. We're paying 15.3% in self-employment taxes on the full $100,000 that our business profited. So we're paying $15,000 in self-employment taxes. Let's just use easy math. Let's say we took half of that. Let's say we set a reasonable salary based on the work that you were doing in your business was $50,000 a year. We're going to pay self-employment taxes on that $50,000, so roughly $7,500 in self-employment taxes, but we're going to avoid self-employment taxes on the remaining portion, the amount that we did not take as a salary. We're still going to pay our normal income tax rate on everything, but we're avoiding self-employment taxes on the money that we did not take as a salary. So in that instance, on someone making $100,000 a year by electing S-Corp status and assuming rough numbers that they took a salary of $50,000, they saved $7,500 in self-employment taxes simply by electing to be an S corporation. And this is the beauty, this is the power behind an S corporation, is this simple ability to lower the amount that we pay in self-employment taxes. Now, there are some added costs and added items when it comes to an S corporation. We now need to run payroll to ourselves as the owner, and we always would recommend running that through a payroll software, which costs some money. And we also now have to file a separate business tax return for our S corporation. All the income and profit from that S corporation are still going to flow through to us like usual, but we have to file a separate business tax return in addition to our personal tax return. And that might have some added cost. And so because of this reason, we typically say that you want to wait until your business is profiting roughly $50,000 or more, and then we can start to look at the S corporation route. Because at that point, your tax savings, your self-employment tax savings are going to far outweigh any kind of added cost that you have on it. In a simple point, that's the benefit of an S corporation, is that you're going to pay less in self-employment taxes, because now, instead of paying self-employment taxes on 100% of our income, we're only paying self-employment taxes on the amount that we take as a salary, and the amount that we don't take as a salary, we avoid self-employment taxes on. Now, since we can only cover this specific reason in a small amount of detail here, I don't want you to leave this video and fall into the content trap, where you become so wrapped up in generalized advice that you never take action, especially with year-end around the corner. It's really important that you don't miss out on the deductions that the IRS doesn't want you to know. So to help you out right now, I've created a free document with every single tax deduction you can use for your business completely for free. To get access, click the link below and start saving thousands of dollars right away. Okay, let's go to item number 2 on what changes when you decide to become an S corporation. So we decided to become an S corporation. We're already seeing the self-employment tax savings. That's great. The next piece is that we need to optimize our salary, because remember, with an S corporation, we're required to take that reasonable salary. In that month that we don't take as a reasonable salary, that's where the savings are. That's where the self-employment tax savings are. So we need to find that optimized salary. What is a reasonable salary for the work that you're doing? And it's important to drill this number. We don't want to take too much of a salary, because if we take too much, we're paying more in self-employment taxes than we need to. We also don't want to take too low, because if we take too low, now we become part of the IRS radar and they're saying, hey, you didn't take enough, you didn't take a reasonable salary, so we're going to bump up your reasonable salary to cover that. So we wanted to do an optimized salary, find the perfect mix of what is a reasonable salary that's not too high and not too low, and that's going to bring us the best tax savings while also protect us from an IRS audit. And typically when we say, let's optimize your tax salary, we say, a good starting point is, what would it cost someone to come in and do what you're doing for your business? What would you have to pay somebody to do what you're doing? That's a good starting point on what a reasonable salary is. From a rough number, typically that reasonable salary is going to be somewhere in the 30 to 50% of your income. So if you're making $100,000 a year, traditionally a reasonable salary is going to be somewhere in the $30,000 to $50,000 you take as a reasonable salary, and the other part you take as a distribution. But to help back that up and support that, we want to find some proof. We want to find some ways to back that up. So oftentimes I tell business owners, count how many hours a week that you're doing the different tasks in your business. Let's say you're an attorney. How many hours a week are you being an attorney? Are you actually practicing law? How many hours a week are you doing administrative work for your law firm? That could be bookkeeping, advertising, those different things. And then how many hours a week are you doing marketing for your firm? And so we take all those hours and we find out what someone in your area would be paid for those various things. So let's say you spend 10 hours a week actually practicing law. So we're going to find out what 10 hours is on a weekly basis and what the hourly rate is for an attorney in your area. Let's say you do 20 hours a week doing administrative work. Okay, we're going to take 20 hours and then find out what the hourly rate for administrative type work is in your area. And let's say you spend 10 hours on marketing. We're going to take 10 hours and find the hourly rate for someone doing marketing in your area. And then we're going to annualize those numbers and come to a salary. And this helps back us up. If the IRS comes knocking, we can say, hey, here's the proof that we can use to back up our salary. But again, when we look at a salary in an S corporation, if we take too much salary, we're paying more self-employment taxes than necessary. If we take too little, then the IRS could come knocking. So we want to take the time to optimize our salary. Again, rough numbers, if we're doing back of the napkin calculations, we're typically saying 30 to 50% of your profit should be in the form of a salary. So if you're making $100,000 a year, $30,000 to $50,000 should be in that range of where your reasonable salary will come in at. Because remember, as an S corporation, we take our total profit, the amount we take as a salary, we pay self-employment taxes, but we avoid it on the rest. So if we're making $100,000 a year and we take a $60,000 salary or a $40,000 salary, we pay self-employment taxes on $40,000, but the remaining $60,000 we avoid self-employment taxes on. And that's the beauty behind it. So it's not just choosing an S-Corp election, but it's now then once we've chosen that and made that decision, we need to optimize our salary to make sure we're not taking too much, to make sure we're not taking too little. And that is the key part there. Now, the next item when it comes to what changes now that we're an S corporation, what things do we need to know about? What things do we need to do properly is we need to treat health-related items correctly. And specifically, I'm talking about self-employed health insurance and maybe health savings account contributions. So remember, when we talk about this idea of S corporation, we see self-employment tax savings on the piece that we don't take as a salary. But here's a really cool thing. When we have health insurance premiums that we paid for ourselves as the business owner of the company, we need to treat it specifically in a certain way, especially when we're an S corporation. As an S corporation, we need to pay for those health insurance premiums out of the business account. We then need to, at the end of the year, add those health insurance premiums to box 1 of our W-2, and then we're going to get a deduction for those health insurance premiums on our personal tax return. So a lot of hoops that we got to jump through. The end result is we get a deduction for our health insurance premiums. Remember, it goes, we pay for them through the business, we add them to our W-2 as income, box 1 only, and then we take the deduction on our personal tax return. But here is the beauty behind this. The self-employment taxes that you pay on salary type income is in box 3 and 5. Those are the wages that get hit with self-employment taxes. Box 1, if we can add items to Box 1 and avoid Box 3 and 5, that means that we're still taking a reasonable salary, but we're not having to pay self-employment taxes on that reasonable salary. So let's say that we determined that a reasonable salary for you was $50,000, but you have $10,000 in self-employed health insurance premiums. In that instance, we would run payroll for $40,000 and pay self-employment taxes on $40,000, and then we would add to our W-2 Box 1 that $10,000 in self-employed health insurance, which brings our reasonable salary up to $50,000, but we're only paying FICA taxes. We're only paying self-employment taxes on $40,000 because $10,000 of that $50,000 was related to self-employed health insurance. So this is a key thing that can really help in that optimizing your salary, but also saving you money, saving you even more in self-employment taxes by utilizing the self-employed health insurance deduction correctly. So if you're set up as an S corporation, we need to make sure we're doing this properly. Again, pay for the health insurance in the business. We add it to W-2 Box 1 of your W-2 wages in your salary, and then we get the deduction on the personal return. The net result is we get a tax deduction for our health insurance premiums. We just have to jump through some hoops to get it, but those hoops are a good thing because they increase our reasonable salary to where it needs to be without having to increase the amount that we pay in FICA taxes and self-employment taxes. This works the same for a health savings account. A health savings account is an account that we recommend everybody, if you have a high deductible health plan and you qualify, we say everybody should be maximizing a health savings account because we consider it sort of like a retirement account on steroids. This is the same way. If you're paying for those HSA contributions through the business, those are another one of Box 1 items that avoid Box 3 and 5. So make sure you're treating your health-related items correctly with an S corporation. Now, with so much information out there on how to optimize your tax plan, it's really hard to find information that will truly set you up for success. So if you're serious about making your tax plan a priority, you need every part of it to be fully optimized. So if you want to fully optimize your tax plan, click the link in the description below and we can help you out there. All right, let's get back to the video. What else changes when you go down that S-Corp route? And the next piece I want to talk about is this idea of an accountable plan. And basically what an accountable plan does is it allows you to get a business expense by paying yourself for items at the business for business use of personal related items, and you pay no taxes on that money received. Business deduction, you pay no taxes on it. Who wouldn't want to take advantage of that? So what does an accountable plan do? And why would we have an accountable plan? An accountable plan is simply just a document that we put on file that says it's a fancy word for a reimbursement policy. And basically what an accountable plan does is it says for any business-related items that you paid for personally, the business is going to reimburse you for them. The business gets a tax deduction and you pay no income taxes on that reimbursement. Again, if you have business-related items that you paid for personally. Now, of course, if you have a business expense, don't pay for it personally, just run it through the business. Where an accountable plan comes into place is when you have items that are both business and personal mix. An item that is mostly personal use but has some business use. And so think of things like a home office deduction. Home office is mostly going to be a personal item, but you're running your business out of there. So you want to get a business deduction for that home office. So that's where you utilize an accountable plan to reimburse yourself personally for the home office, the business use of that home office. Think of things like a personal automobile that has some business use, or maybe your cell phone or internet costs, or maybe travel costs where you're mixing business and personal pleasure, but you still want to get a reimbursement. You still want to get an expense for the business items. When you're set up as an S corporation to properly do this to where you get a business expense and you pay no taxes on that money received, you need to have a properly set up accountable plan in place. And this can be super powerful. Again, this is your vehicle. This is your tool to get a business deduction for business use of a personal automobile. This is your opportunity to get a business deduction for that home office that you're operating out of in your home. This is your opportunity to get a business deduction for that cell phone and internet cost that has some business use, and those travel items that have some business and personal mix. So accountable plan is a tool that you use to reimburse yourself for items that you paid for personally that have some business use, and that reimbursement means that you get a business deduction and you pay no income taxes on that. The next piece that changes when you have an S corporation that can really take this idea of an S corporation and start to explode and open up so many opportunities is when you optimize an S corp and utilize it as a core structure when you are involved in multiple businesses or you're involved in a partnership with multiple owners. So let's talk about multiple businesses. Our favorite setup when we have an S corporation and we're invested or we're owners of multiple businesses is to have one S corporation that we own 100% of. And that S corporation we like to call a holding company or a management company. So we have an S corporation that we own 100% of, and then any other business that we're associated with is going to be 100% owned by that S corporation. So it might be a business that I 100% own, and so we have an LLC that's 100% owned by my S corporation. I have another LLC that's 100% owned by my S corporation. Or maybe I have just a DBA that's 100% owned by my S corporation. But where this can also come to play is, let's say you have a business that you're a partner in. You just own a portion of that business and you have a partnership in that business, but you own 10%. Well, your 10%, you got it. It's going to be owned by your S corporation. And what this does is it ensures any businesses that you're actively participating through are flowing through an S corporation prior to touching you, which is making sure that you're minimizing the amount that you pay in self-employment taxes. Now, one key part to this is that we talk about the benefits of an S corporation is to lower the amount that you pay in self-employment taxes. If you are passively investing, you're put money into a business, but you're not actively managing it, or you bought a rental property, but you're not actively involved in it, you do not pay self-employment taxes on passive type activities. So we do not want passive activities in an S corporation. Those are going to be on another side of those can just be an LLC, no S corporation. But when we're talking about S corporation and your ownership, your management company, your parent company being an S corporation, we're talking about businesses that you're active in. You're actively participating in the management, the running of it, and everything else. That's where the S corporation brings some power. The other piece on why, when you have an entity with multiple owners, on why having the owners own their share through an S corporation can be so powerful is it allows you to maximize tax savings. Like we talk about all the time. Think of this idea of hiring your kids in your business, which is a super powerful strategy. If you have a partnership, your partners might say, we don't really want you hiring kids in the partnership because they don't bring value. But if your ownership is through an S corporation and profits from that partnership go through to your S corporation, you can hire those kids in your S corporation and do what you want to do. Maybe you have a partner that has no kids. Maybe you have 5 kids, and it might create some conflict of hiring 5 kids if he's hiring none. When we do the setup with an S corporation on top that you own 100% of, and any of your ownership in any other active businesses through your S corporation, you can do so much tax planning at that S corp level. And so that's how we can optimize an S corporation when you have ownership in multiple ventures or you have ownership in a partnership. So let's kind of revisit where we've been. Again, the goal in the big aha moment when it comes to an S corporation is the ability to save on self-employment taxes, to lower the amount that you're paying in self-employment taxes, which is 15.3% on the profit of your business that we can lower if we simply elect S-Corp status. Now, with an S corporation, we need to make sure we're optimizing our salary to the best of our ability. We want to make sure that we're not taking too high of a salary and paying way too much in self-employment taxes that we need to. And we also want to make sure we're not taking too low of a salary or no salary that would put us on the IRS radar. So we want to take a salary that makes sense. And then when we're an S corporation, we need to make sure that we're treating health-related items correctly. We need to make sure self-employed health insurance is treated correctly. Where we pay through it for the business, we add it to box 1 of our W-2, we get the deduction on our personal tax return, but those insurance premiums that we're paying add to our reasonable salary, but we don't get hit with self-employment taxes on those insurance premiums, which is a great, great benefit that you have as an S corporation owner. And then we also talked about the need for an accountable plan. This is a way to reimburse yourself personally for items that you paid for personally that are business related, where you can get a business expense and pay no taxes on that money that you received. Think of things like business use of a personal automobile, home office, cell phone, internet, travel, those types of items. And then when we do full picture of where an S corporation can play such a big role in your entire picture is when we optimize multiple ventures. If you have multiple businesses that you're an owner of, you're going to have those ownerships through that main management S corporation that you own 100% of. If you have a partnership where you have multiple partners, you're going to have a partnership, and each partner is going to have an S corporation that they have their ownership shares through. Now, one bonus topic on what changes with an S corporation is that it lowers the audit risk. Traditionally, S corporations get audited much lower than, say, that of a sole proprietorship. And so not only do we have all of these other added benefits, the lower self-employment taxes, all these other great things that we can get out of an S corporation, it also brings us less risk to an audit. That's a win-win situation. Now that you know how an S-Corp can transform your tax plan, you need to understand one thing. These tax advantages are just the beginning of what an S-Corp structure can do for your wealth. You can't walk away from this video thinking that simply filing as an S-Corporation will automatically optimize your tax situation. After helping thousands of business owners transition to S-Corps, we've uncovered opportunities that most tax professionals completely overlook. The reality is that the real power of an S-Corp isn't just about saving on self-employment tax. It's about creating an entirely new framework for building personal wealth. Between payroll optimization, retirement plan strategies, and strategic profit distributions, we've found that proper S-Corp management can dramatically accelerate your path to financial freedom. So, if you're ready to fully optimize your tax strategy, click the second link in the description and get started now. We'll see you on the next one.